Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive. We are kicking off the new year with some heavy artillery, and honestly, this might be the most consequential analysis we do all quarter. Today, we're breaking down one of the most interesting companies on the market. I'm talking about the absolute titan of the luxury world, LVMH, Louis Vuitton, Moët, Hennessy. But listen, we aren't just looking at this as a brand that, sells handbags. That is way too simplistic. We are looking at this company as the bellwether, the signal for the entire global luxury economy. We're recording this on January 30, 2026. And the stock is hovering around, 590 euros, giving it a market cap of roughly 295 billion euros. So on the surface, it's a fantastic business, an unbelievably powerful brand. I mean, it has historically been what we'd call a forever stock with just seemingly invincible pricing power. But the real question for us, as long-term investors is this: are there hidden cracks in that fortress that the market is ignoring?
Because we're looking at the 2025 data, and it's showing organic revenue declining by about 1%. So have we finally hit a structural wall, a point where exclusivity is turning into Mastige, or we're looking at a classic value trap or generational buying opportunity? That's what we're here to find out.
That's a huge topic. And before we dive deep, a quick heads up for the audience.
Right. If you're looking to execute on these ideas, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business engine and the moat analysis.
Okay, let's unpack this beast.
Yeah.
I think a lot of people look at LVMH and they just see retail. They sort of compare it to a Target or a Macy's, just with, higher prices.
Yeah.
But economically, it functions in a completely different universe, doesn't it?
Yeah.
It's all built on this concept of Veblen goods.
It is entirely different. I mean, if you model LVMH like a standard retailer, you will lose money, period. Standard economics, Econ 101, it teaches us about the demand curve, right? As price goes down, demand goes up. If Walmart cuts the price of a toaster, they sell more toasters. It's simple. LVMH operates in a complete economic anomaly, a reverse reality where price is a signal of value, not a friction.
Meaning, if the price is too low, people they don't want it.
Precisely. It's counterintuitive. If I offered you a brand new Louis Vuitton Capucines bag right now for 200 euros, what would you think? You wouldn't be excited.
I'd be suspicious. I'd think it was a fake.
You'd be suspicious. You'd assume it's a counterfeit, or worse, that the brand has lost its cachet and nobody wants it anymore. But if I put that same bag in a glass case, light it perfectly in a beautiful store, and price it at 7,000 euros, suddenly there's a waiting list.
It's psychological magic, really. The pain of paying that high price is actually part of the pleasure of owning it. It verifies that you belong to a certain club.
That's the Veblen effect in a nutshell. And from a strictly financial perspective, before we even get to the fashion or the brand, this creates a cash conversion cycle that is the envy of the entire business world. I mean, think about the mechanics here. In a normal business, you buy raw materials, you pay to make the product, you ship it, it sits on a shelf, someone buys it on credit, and maybe 30, 60, 90 days later, you finally get paid.
You're outlaying cash constantly. It's a constant drain.
Right. But now look at LVMH. For their highest end items, we're talking high jewelry, bespoke trunks, limited edition watches. The customer often pays upfront. Or they pay a massive deposit months, sometimes a year, in advance. LVMH is sitting on the customer's cash before they have even finished manufacturing the product. They are essentially operating with negative working capital requirements in those segments. They are funding their operations with their customers' money.
That is a beautiful thing. It's like an insurance float, but for purses. But this all hinges, and I mean entirely, on that pricing power. We've always talked about their Power 5 pricing capability.
We call it the Power 5 in our internal framework, yeah. It refers to the company's historical, almost magical ability to raise prices on their core scuffs. The icons, the Lady Dior bag, or the LV Neverfull by roughly 5 to 10% annually, like clockwork.
And this was regardless of what the economy was doing. Recession, boom, didn't matter.
Exactly. Inflation is 2%, they raise prices 8%. Inflation is 5%, they raise prices 10%. For a decade, they were beating inflation without even trying, and the volume didn't drop. The customer didn't even blink. It was an automatic compounding machine.
But, and this is the big but, here's where it gets really interesting. And frankly, this is what has me worried. The data from 2024 and 2025, it suggests that this superpower might be fading. We saw organic revenue decline by about 1% in 2025. That hasn't happened outside of a major global crisis in a very long time.
This is the limit test we've been waiting for. We've been talking about it for years. For a decade, analysts have asked, how high is too high? You know, can you charge $10,000 for a canvas bag? $15,000. We're finally seeing the answer. And we're seeing what I call the reverse lipstick effect.
Okay, explain that. Because usually the lipstick effect is a good thing for these companies during a downturn.
Right. The traditional lipstick effect says that when people can't afford a house or a car because of a recession, they still want to feel good, so they buy small luxuries, a premium lipstick, a bottle of perfume, an accessible treat. But what we are seeing now is different. The price hikes of the last 3 years were so aggressive, so relentless, that they finally broke the elasticity of demand at the aspirational entry level.
The aspirational customer.
Yeah.
So the person saving up for their first LV bag, they just got priced out completely.
The customer's wallet broke before the brand's pricing strategy did. That entry-level consumer, the one who buys the small leather goods, the wallets, the accessories, they have pulled back significantly. They aren't buying a lipstick to feel better. They are just not buying. They're paying rent.
So the volume is dropping at the bottom of the pyramid. That forces us to really scrutinize the moat. We throw that word around a lot, but for LVMH, it's actually two very different moats, isn't it?
Yes. It's critical to distinguish between the intangible and the tangible. The primary moat is what we call effective valence.
Which is just a fancy way of saying emotional stickiness, right?
It's the psychological hold the brand has on the consumer's identity, on their aspirations. It allows them to charge premiums of 10, 20, even 50 times the production cost of an item. You cannot replicate that with money. You can give me $10 billion tomorrow, and I cannot build a brand that has the same trust, heritage, and cultural weight as Louis Vuitton. It's been around since 1854. You just can't buy history.
It's a stock of trust that has been compounding for over a century. But there is a secondary moat that I think is even more important, maybe because it's harder for people to see, the cornered resource.
This is the tangible side. This is the hard asset power. LVMH isn't just a brand manager. They are a real estate tycoon. People forget this. They own the absolute prime locations, the best corners on the planet. We're talking Champs-Élysées in Paris, Fifth Avenue in New York, Bond Street in London, the Ginza district in Tokyo.
And they don't just lease them. In many cases, they own the buildings. They own the dirt.
They own the dirt. And think about what that means strategically. If a competitor, say a hot new luxury brand backed by private equity, wants to compete, they have to rent a space. Who are they often renting from? Or who are they bidding against for that lease? LVMH can afford to pay rent that makes zero economic sense for anyone else, because for them, the store is a marketing billboard that actually pays for itself.
It's a weapon. And it goes upstream, too, to the supply chain.
Correct. They have vertically integrated to an obsessive, almost paranoid degree. They own the tanneries that make the absolute best leather. They own crocodile farms in Australia to secure the supply of exotic skins. They own the intricate supply chains for rare gems through Bulgari and Tiffany. So a competitor might have the capital to build a factory, but they cannot get the raw materials. LVMH has literally locked up the supply of the best stuff.
So even if you wanted to make a better bag, you couldn't get the quality of leather to do it. That is a fortress. But I want to apply a Charlie Munger mental model here, the Lollapalooza effect.
One of the best mental models out there.
It's when you have multiple biases or forces that all converge to drive a massive outsized outcome. For LVMH, you have social proof. Everyone wants the bag because they see celebrities and influencers with it. And you have scarcity. They create these artificial limits on how many they produce.
And when you combine social proof and scarcity with that insane pricing power we just discussed, you get a feedback loop where higher prices actually increase desire. That has been the engine for the last 20 years. But we have to introduce the premortem, Munger's other great tool, inversion. How does this company die?
It dies if that exclusivity is lost, if that feedback loop reverses on itself.
Exactly. If the social proof shifts from everyone cool has this to everyone has this, so it's not cool anymore, the company is in deep, deep trouble. We call this the risk of becoming Mastige mass prestige.
And I feel like we saw this happening between 2021 and 2023. The aggressive expansion. The ubiquity of the monogram canvas. You couldn't walk through an airport lounge or a nice mall in any major city without seeing 50 Neverfulls.
It became the uniform for a certain class.
Right. And when luxury becomes a uniform, is it still luxury? Did they fly too close to the sun there? Did they get greedy?
The recent revenue stall suggests they might have touched that third rail. They flooded the market to capture the post-COVID boom, all that revenge spending.
Yeah.
And they made an absolute fortune doing it, make no mistake. But the hangover is that the brand equity got diluted. It got a little common. So now they have to pull back to regain that scarcity. It's an incredibly delicate dance. You have to start telling people no again after saying yes to everyone for 3 straight years.
Let's talk about the man conducting that dance. Bernard Arnault. He has a very specific management style that seems designed to counter this very risk, the Arnault Doctrine.
This is soft power versus hard power. It's his genius, really. Most conglomerates, when they get this big, they diversify, as Peter Lynch would say. They add layers of bureaucracy, middle management, consultants. That kills creativity. Arnault does the complete opposite. He uses a decentralized autonomy model for the creative side of the houses.
So the creative director at Lowe or Celine, they don't have to check with headquarters about the color of a button or the theme of a runway show.
Right. If Jonathan Anderson at Lowe wants to make a bizarre, surrealist collection with, pixelated T-shirts, he just does it. The soul of the Maison is preserved. It stays cool. It stays relevant. But the hammer is centralized. Media buying, real estate negotiation, legal, logistics, that is all handled by the central LVMH group.
So when they go to buy ad space in Vogue or on Meta, they aren't negotiating as tiny little Lowe. They're negotiating as LVMH, spending billions of dollars.
Exactly. They get rates that no standalone brand could ever dream of. They get the prime location in a new mall for a fraction of the cost per square foot because the mall owner needs LVMH more than LVMH needs that mall. So you get the agility and coolness of a boutique fashion house backed by the brute force of a 300 billion euro balance sheet.
He lets the artists be artists, and he lets the accountants be sharks.
That is the perfect way to put it, yes. And that structure is what gives them resilience. It allows them to swap out creative directors if a brand gets stale without blowing up the whole company. But speaking of the accountants and the sharks, let's move to pillar number 2. We need to look at the financial resilience and capital allocation. Because the narrative is great, but the numbers in 2025 they were messy.
Okay, let's get into the numbers. Because looking at the 2025 report, there are some definite yellow flags that we can't just ignore.
There are. Let's start with the quality of earnings and specifically the margins. We saw operating margins compress. They went from a peak of around 27% down to roughly 23% in 2025. For a company of this caliber, that is a significant drop.
That's a huge drop, 400 basis points. What's driving that? Is it just that they sold fewer bags?
It's a concept we call negative operating leverage. And let me just explain the math here because this is so crucial for understanding luxury economics. LVMH has a very, very high fixed cost base. They have these massive flagship stores, the temples of luxury on the best streets in the world. The rent, the staff, the lighting, the security, that costs the same whether one person walks in or 1,000 people walk in.
The overhead is absolutely massive.
Right. And they also have these huge marketing commitments. They can't just stop advertising because sales are slow. If they do that, they lose relevance. The brand dies. So when revenue drops, even just by 1%, as it did, those costs don't drop with it. In fact, they might even rise due to inflation. So that missing revenue falls straight to the bottom line. It wipes out profit disproportionately.
So if revenue drops by 1%, profit might drop by 10 or even 15%.
Exactly. That is the double-edged sword of operating leverage. It's glorious. On the way up, when you sell one extra bag, almost all of it is pure profit. But on the way down, it just eats you alive.
Okay, however, there is a silver lining in the numbers that I love, and it really distinguishes them from the U.S. tech giants we usually talk about on this show. When we analyze a Google or a Meta, we always have to adjust for stock-based compensation.
The SBC reality check. Always.
Exactly. We look at companies in Silicon Valley, and their free cash flow looks amazing until you realize they paid their employees $5 billion in stock options. It's a hidden expense to shareholders. It's dilution, LVMH. Their stock-based compensation it's negligible.
It's practically non-existent relative to their size. I think the number was about 227 million euros on 85 billion euros of revenue. It is a rounding error.
That is incredible discipline. Why is that? What's the thinking there?
It's cultural, it's very European, and specifically it's part of the Arnault empire's philosophy. They believe in paying cash for talent, not equity. They treat equity like it's gold. They don't want to dilute the shareholders, which, remember, includes the Arnault family as the largest shareholder, just to pay a marketing manager.
So when we see their free cash flow number, it's real. It passes the gold standard test. It is not being subsidized by shareholder dilution. It's clean.
It is extremely clean. What you see is what you get.
Okay, so the earnings are high quality, even if the margins are a bit compressed right now. But I want to challenge you on the return on invested capital, the ROIC. This is a key metric in our synaptic framework, and usually we demand over 15%. That's our hurdle.
And this is the big red flag on the dashboard. You're right to point it out. Currently, LVMH's ROIC is sitting somewhere between 10 and 12%.
Ouch. That is getting dangerously close to their cost of capital.
Right. If you assume their weighted average cost of capital, their WACC, is around 8 or 9%, which is reasonable given current interest rates, then a 10 to 12% ROIC means they are barely creating any economic value. They are treading water. If that number drops below the cost of capital, they are technically destroying value every day they operate.
So is this a structural problem? Has the business just become too capital intensive to be a great business anymore?
I would argue it's context, not structure. You have to look at where all that capital went. Arnault is an outsider CEO in the mold of the famous book by William Thorndike. He does not care about next quarter's ROIC metric. He couldn't care less. He is willing to sacrifice short-term metrics for generational asset accumulation.
This is the digestion phase.
Exactly. Look at what they bought in the last few years. They bought Tiffany & Co. for $16 billion. They bought Belmond, the luxury hotel group that owns properties like the Cipriani in Venice. They are spending billions renovating flagship stores, like the Landmark on Fifth Avenue in New York.
That store alone cost something like $500 million to renovate, wasn't it? An astronomical sum.
It was. But all that capital expenditure, all that investment sits on the balance sheet. It balloons the denominator of the ROIC calculation. But the earnings from those assets, the fully ramped up Tiffany, the reopened hotels, they haven't fully hit the numerator yet.
So they are planting trees today that will provide shade in 10 years.
They are planting entire forests. They are building assets that will be printing money in 2035 and 2040. But right now, on a spreadsheet in 2026, it looks inefficient. If you are a short-term trader, you hate this. You sell the stock. If you are a generational holder, you understand it. You might even like it.
Okay, so if we trust in that outsider mentality, we can forgive the ROIC dip as a temporary digestion issue. Let's move to pillar 3 then. Growth, valuation, and fair value. Because at the end of the day, we need to know what this thing is actually worth.
We do, and we have to start by understanding that the growth engine has fundamentally changed. If you are betting on LVMH simply selling more units, more bags, more wallets, you are going to lose.
It's no longer about volume growth. That story is over.
No. The aspirational middle-class engine, the dentist in Ohio or the office manager in Shanghai buying their first Neverfull, that engine is stalled. We just can't count on it for growth anymore. The total addressable market, or TAM, for that consumer is now constrained. The new TAM is the ultra-high net worth individual.
So growth has to come from elevation, from moving up the price ladder.
Correct. It's about selling one 50,000 euro Tiffany necklace instead of 25 2,000 euro bags. It's about selling a bespoke trunk for 100,000. The pool of customers is much, much smaller, but they are completely recession-proof. They don't care if gas prices go up or if the stock market has a bad week.
Okay, with that in mind, let's run the reverse DCF. We love this tool. Instead of us guessing the future, let's ask, what future is the market pricing in right now at 590 euros a share?
So, at a glance, the stock is trading at a PE of about 23. The 10-year average is closer to 25. So on that metric, it looks slightly cheap. But if you run the math on the cash flows, what the market is pricing in is a soft landing. The current price assumes LVMH will return to 6 to 8% growth by 2027 and maintain those compressed margins.
And that feels optimistic. That is a big assumption given the macro backdrop we've been talking about.
It is. The market is not pricing in a prolonged luxury depression. If growth stays flat, say 0 to 2% for the next few years because China doesn't bounce back or the US has a hard landing, then fair value isn't 590, it drops significantly. Our model shows it dropping to around 450 euros.
So there is real, tangible downside risk here. The market is definitely optimistic. Let's try to triangulate the intrinsic value using our 3 methods to get a clearer picture.
Okay. Method 1, historical mean reversion. This is the simplest one. If we take normalized earnings per share of about 26 euros, that's assuming margins recover just a little bit, and we apply the historical 25 times multiple, we get a value of 650 euros.
Okay, so that implies about 10% upside from today's price. Method 2,
Analyst consensus. The average price target on the street from Morgan Stanley, Goldman, all the big banks is also clustering right around that €650 mark.
So the street agrees with history. No surprise there. And method 3, owner earnings.
This is my favorite. This is the Buffett method. If we look at their sustainable free cash flow of roughly 14 billion euros and apply a 25 times quality premium ban, because as we said, the earnings are clean and the moat is incredibly wide, we get to a value of 700 euros per share.
So we have this cluster of value between 650 and 700, but the stock is at 590. Is that enough of a discount for you to get excited?
Personally, no, it's not.
Why not? I mean, it's trading below what we think is its intrinsic value.
Because of the margin of safety,
Right.
or the lack thereof. We are looking at a potential structural shift in the global economy. Given the China risk, given the margin compression, I wouldn't want to buy this stock unless I had a 20% buffer, a 20% margin of safety against my downside case.
So where is the buy zone? Where would you tell someone it's time to back the truck up?
I and the team have pegged the buy zone for LVMH between 500 and 530 euros.
So at 590, it's a hold. It's at fair value, but it's not a table-pounding buy.
Correct. You are paying a fair price for a wonderful company. And as Buffett says, that's far better than a wonderful price for a fair company. But you aren't getting a bargain. You are paying full retail for a luxury good.
And we prefer to buy our stocks like we buy our winter coats on sale in the summer. And the reason we demand that bargain is pillar number 4, the red team challenge. We need to seriously consider the bear case. And frankly, this is the part of the script that kept me up last night.
It should. This is where we have to take the rose-colored glasses off and get serious. The strongest argument against owning LVMH right now isn't about handbags. It's about history. Specifically, it's about the Japan 1990 parallel.
Walk us through that, because I think people today forget that Japan used to be the luxury market in the world.
In the late 1980s, Japan was the engine of the luxury world. It was exactly what China has been for the last decade. Asset prices were insanely inflated, real estate in Tokyo was booming, the Nikkei was at all-time highs. The Japanese consumer felt infinitely rich. They were buying European luxury like it was water. They were buying the actual buildings in Paris and New York.
The wealth effect was just completely off the charts.
Totally. And then the credit cycle burst. Real estate bubble popped. The stock market crashed, and importantly, it didn't recover for 30 years.
And we entered the famous lost decades.
Exactly. And here's the key point for investors today. Luxury is a lag indicator. It didn't crash immediately in 1990. It held up for a little bit, and then it fell off a cliff.
Yeah.
The demand just evaporated because the psychological feeling of wealth evaporated.
And you see a direct parallel to the world today.
Look at the 2020 to 2023 boom. What fueled it? Global stimulus, 0% interest rates, free money, crypto bubbles, SPACs, a roaring stock market, real estate inflation. Everyone felt rich, so everyone went out and bought luxury. But now we're entering a luxury winter. We are seeing signs that the global consumer is deleveraging.
So if the Chinese consumer and the American aspirational consumer pull back the way the Japanese did in the 90s, we aren't looking at a one-year dip. We are looking at a potential decade of flat demand.
And that is a value trap. The trap is paying 23 times earnings for a company that faces 10 years of stagnation. If the market decides LVMH is no longer a growth stock, but just a consumer staple, a boring dividend payer like a Procter & Gamble or a Coca-Cola, the multiple compresses, it has to. It goes from 23 down to 18, maybe 17.
And if you put an 18x multiple on flat or slightly declining earnings,
The stock goes to 450. You lose 25% of your capital just on the multiple compression, even if the business itself doesn't collapse. That is the nightmare scenario for a shareholder today.
and it's compounded by the China decoupling risk. This isn't just about economics, it's also political.
Absolutely. China was, at its peak, about 30% of sales. But with the common prosperity drive from Beijing, the government is actively discouraging the conspicuous display of wealth. It is now frowned upon to flaunt a big logo when youth unemployment is at 20%.
That's a vibe shift, a cultural shift.
It's a regime shift. And if the Chinese consumer never returns to 2019 levels of spending because the culture has permanently changed, that 30% of the business is structurally impaired. Maybe forever.
Okay, that's bleak. I have to play the bull case rebuttal here. I have to defend the fortress.
Please do. Give me some hope.
The rebuttal is hard luxury, watches and jewelry. LVMH has pivoted hard into this with the acquisitions of Tiffany and Bulgari. These categories are much more resilient than fashion. A gold bracelet is an asset. A Patek Philippe watch is an asset. A leather bag is ultimately a depreciating consumer good. In uncertain times, people move their money to hard assets.
That is true. Hard luxury does hold its value better. It's a store of wealth, not just a fashion statement.
And regarding the margins, I'd argue that 23% is the floor, not the new normal. They are still spending heavily on marketing right now because they are playing offense while everyone else plays defense. If they really wanted to, they could cut that marketing spend tomorrow and margins would pop right back up to 26% almost immediately.
That is a fair point. They have a lot of fat they could trim if they really needed to boost profits. They're choosing not to in order to protect the brand's long-term visibility and desirability. And that is a luxury that only a company with their balance sheet and market position really has.
So we have the bear case and the bull case. Let's try to look past the current noise. Pillar number 5, the horizon. Looking out to 2030, maybe 2035. What does this company actually look like in 10 years?
This is the vision part. And the core thesis here is that LVMH is evolving. It is moving from being a product seller to becoming what we call a cultural sovereign.
I love this concept. The selling leather bags model is, in a way, depreciating. It's too transactional for the future.
It is. By 2030, LVMH doesn't just want to own your closet. They want to own your life. They are blurring the lines between luxury goods, five-star entertainment, and exclusive hospitality.
The White Lotus effect, as you've called it.
Exactly. I want you to imagine a client in 2030. She flies to Paris. She stays at the Cheval Blanc Hotel that's owned by LVMH. She shops at the new Louis Vuitton flagship, LVMH. She eats dinner at a restaurant owned by the group. She drinks Moët and Chandon at that dinner, LVMH. She might even read a review of the restaurant in the Parisian newspaper, which is also owned by LVMH.
They own the entire leisure time, the entire aspirational experience of the ultra-high net worth individual. They are capturing the spend at every single touch point.
It creates a powerful flywheel. The hotel experience reinforces the desire for the fashion, which reinforces the status of the wine. It's an ecosystem of status. You aren't just buying a product anymore. You are living inside the Arnault universe.
And they are backing this up with something they call Vertical Integration 2.0. This Life 360 plan they talk about in their sustainability reports.
This is fascinating. Most people dismiss this as just ESG marketing fluff. Oh, look, they care about the environment. But it's actually a strategic weapon. They are targeting 100% traceability and zero sourcing from high-risk environmental areas by 2030.
Why is that a weapon? How does that help them sell more?
Because it is insanely, prohibitively expensive. It costs a fortune to track every single crocodile skin from the egg to the handbag, to track every diamond from the mine to the ring with blockchain. Smaller brands, your competitors, they simply can't afford to do it.
So as government regulations get tighter on sourcing and ethics, LVMH is the only one who can actually comply.
Exactly. LVMH is building a regulatory moat. In a world where consumers and governments demand ethical sourcing, LVMH will be the only one who can prove it at scale. They are turning a compliance cost into a barrier to entry that could bankrupt their competition.
That is brilliant. That is playing 4D chess. But we have to talk about the elephant in the room, the key man risk.
Succession. Bernard Arnault is 76 years old. He just extended his tenure limit at the company to 85, so he isn't going anywhere tomorrow. But he is mortal.
And it's a real-life Succession TV show playing out. He has 5 children, Delphine, Antoine, Alexandra, Frederic, Jean. They all work in the business. They're all very capable.
The risk is a Game of Thrones scenario after he's gone. If the children start fighting for the throne, it could fracture that delicate, decentralized autonomy that makes the company work so well. You could have factions. You could have gridlock. It could get ugly.
However, the corporate structure, the Agache SCA, is specifically designed to prevent this, right? It's a limited partnership structure.
Yes. It requires unanimous or majority consent for major strategic shifts. It is legally built to keep the empire together. Arnault has spent decades engineering the legal and financial structure to prevent a breakup. But family dynamics are unpredictable. Emotions don't always follow corporate bylaws.
That's true. And finally, where does the growth come from in 2030? If China is slowing down for good.
It comes from the next China. But it's not just one country. It's a whole block of countries. India and Southeast Asia.
Bain & Company projects 300 million new consumers entering the luxury market there by 2030.
And LVMH is already there. They are on the ground. They are signing deals for massive new malls in Mumbai and Delhi. They are expanding their footprint in Vietnam and Thailand and Indonesia. They are positioning themselves to capture that next S-curve of wealth creation early, just like they did in China back in the 90s.
But they have to navigate a new generation. Gen Alpha, the kids who supposedly care more about values than they do about price.
That is the most dangerous transition for any luxury brand. It's pivoting from exclusivity through price, which is, I have this because it's expensive and you can't afford it, to exclusivity through values. I have this because it's sustainable and it was crafted by artisans. It's a tightrope, a very fine line to walk. If they get woke wrong, they alienate their conservative core customer who just wants a status symbol. If they ignore it completely, they lose the youth.
Precisely. And Arnault is one of the very few CEOs who has managed to walk that line successfully so far.
So let's wrap this all up. Let's bring it home with the expected shareholder return profile. If I buy LVMH today and I hold it until 2035, what am I realistically getting?
You need to shift your expectations. The hyper-growth era of 2015 to 2025 is over. It's done. We are now entering the aristocratic compounder era.
And what kind of numbers are we looking at for that?
We're modeling revenue growth of 4 to 6%, not the double digits of the past, but you will see the dividend yield rising. It'll probably get to 2.5% or 3% as CapEx slows down and they stop buying everything in sight.
And what about the multiple?
I think contraction is likely. It will probably settle closer to a 20 times earnings multiple rather than the 25 we've seen historically.
So you add all that up, what's the total return? You're probably looking at 8 to 10% annualized.
That's okay. I mean, it's not going to make you rich overnight.
No, but it's solid. It's a royal bond. You own it for wealth preservation, for inflation protection, and for low volatility. You do not own it hoping for a 10x textile return.
It's not NVIDIA. It's the modern equivalent of having gold bars in a Swiss vaults, but with a dividend and much better marketing.
That's a perfect summary. The days of easy money and luxury are over. The era of hard luxury dominance has begun.
So what does this all mean? Let me leave you with a final provocative thought to chew on. LVMH is no longer just a growth stock. It has become a proxy for global wealth inequality. When you buy this stock, you aren't really betting on the timeless appeal of a handbag. You are making a structural bet on the resilience of the top 0.1%. You are betting that the rich will continue to get richer regardless of what the rest of the economy does. You are, in effect, betting on the widening gap.
That is a sobering thought, but I think the data completely supports it. The wealth of that top cohort has disconnected from the general economy, and investing in LVMH is one of the purest ways to hedge against that reality.
Indeed. It's a hedge against the middle class disappearing.
Remember to check the buy zone numbers in the description. We do update them if the facts change. And if you choose to act on this analysis, please use that affiliate link to get your bonus. It really helps us keep the lights on and keep the analysis deep.
Thank you for listening to this deep dive. Stay curious, stay critical, and we will see you in the next one.
Stay rational.